As a Canadian, we all know that whenever you make money on the American stocks or ETFs, that there is a 15% withholding tax on our income because of the Americans. Now, you can actually claim that usually on your income tax as long as it's outside of a TFSA. However, if you have an RRSP, that's where I would personally hold my American stocks and ETFs, and there is a reason why. Let's get down to it. I already knew this, but I wanted to get a good quote from a reputable source. So this is from Money Sense, and it says right here, U.S. dividends may or may not have withholding tax in your RRSP. If you own U.S. stocks directly in your RRSP, this is actually a very good tax haven, there will be no withholding tax. This also goes for usually capital gains as well from what I have seen. Now, when it comes down to the RRSP, it's a fantastic way to essentially defer taxes. However, we have to remember that even though we are deferring the taxes, we still have to pay them. Now, of course, there's no American withholding tax, so we're not giving the Americans any money. However, there is still an income tax that is paid on any money that is coming out of your RRSP. So we have to remember that with an RRSP, when we put money into it, we don't pay money on that earned income. So for example, if we were to make $1,000, we would be taxed at probably somewhere around 20% for most of us. And then at that 20%, we would then only actually get $800. If we were to stick that $800 into an RRSP, we wouldn't be then essentially paying taxes on that money. And we would then be able to essentially defer and pay that tax later on. Now, for self-employed people, RRSPs are great because we get all of our money up front. We don't pay any taxes up front, so we can stick that whole $1,000 into that RRSP and not pay taxes on the $1,000 part of it instead of just the $800. So from there, it's actually a pretty good tax resource, or at least tax saving resource, especially for us unemployed people. However, when it comes to taxes, would you rather pay your taxes today or would you rather pay them in the future? And that's actually a very good question, because when we're talking about tax savings, yes, it's a great way to save on income taxes on the stocks that we buy and sell. It's a great way to save on dividend earnings from the stocks that we own or ETFs that we own. But if we're only going to be paying, let's say, an income tax of around 20% today, what is our income tax going to be like 40, 30, whatever years down the road? For me, it would be probably 30, 40 years down the road. Are our taxes going to increase? So that is kind of the balance that you have to gauge. So what I'm talking about here is if you're, let's say, 20 years old and you're putting into an RRSP, you might as well actually put it into a tax-free savings account, a TFSA, because if you're only going to be saving maybe 15% or 10% or 20% on your taxes today, you might as well just stick that money into a margin or a cash or even an account or to invest or into a TFSA, because the RRSP will only be saving you that 10, 15, 20%, while maybe 10 years down the road when you're 30 like myself and you're making over, let's say, $100,000, now you're being taxed at 30 something, 40 something percent. And at that point, then you can put it into the RRSP and say, okay, now I'm saving that 30, 40% on whatever money I put into that account. And at that point, you're actually making more money. So sometimes it's actually a better strategy just to wait to put money into an RRSP and see what happens in the future. And that's a great way of really looking at it. But if you're looking for maybe tax advantages for investing in the United States, an RRSP is another great way to do so. But we have to remember that when we withdraw that money from that account, we have to pay taxes on it. So keep that in mind. This is a great strategy if you've got an RRSP, or if you're making enough money to make it viable to put money into an RRSP investing account. Then at that point, it's actually possibly a better route than just investing in American stocks through a margin or a cash account or through a TFSA. I hope that this makes sense. Also, remember that when you're investing in an RRSP, don't go risky, because what will happen is, let's say you put your $1,000 in there and you went super risky, and let's say you went and put $1,000 in and you went super risky and you lost 50% of your money. That is now only worth $500. However, we didn't have to pay taxes on that $1,000, so we were fine. Am I right? So we were fine. We got our full $1,000. We didn't have to pay, let's say, 20%, which would have turned it into $800. Now, by investing into an RRSP and you lost 50% of your investment, you're now down to $500. When you take that money out, let's say you're at a higher tax bracket, and let's say you're now being basically charged 40% because now you're in such a high tax bracket. You now lose almost $200 or so of that $500. If you were to be taxed at 40%, you would have $300 left. And let's say you're in a lower tax bracket, then you would have actually lost even more, because now this original, if taxed, would have been $800. Now it's only going to be worth $400, and you can't even claim a tax write-off on that. Meanwhile, if you were to have that $800, lose 50%, now it's only worth $400, you're still at that same amount. However, now this is a tax loss of $400, while this isn't. So now that $400 that you were taxed at, or you were taxed at $200 originally, which gave you $800. You lost 50%, now you're worth $400. Now you're technically at the same amount. However, that $400 loss in between, that now turns into a bonus for you, because now that $400 that you lost goes against your earnings for that coming year. So sometimes an RRSP isn't exactly the greatest investment tool either. So that's something that you have to keep in mind. When you're investing into a TFSA or into an RRSP, you only have limited contribution room. And in an RRSP, if you lose money on your investments, you're losing even more because of taxes. Meanwhile, if you didn't invest in an RRSP and you went risky, just like you may have in an RRSP, you actually could, if you have a loss, could actually come away with a tax advantage. So keep that in mind. I hope that this information all makes sense. If it does, hit that like button, subscribe. I'll see you guys again next time.